Okay, good afternoon, everyone, and I know we're in the public session, but we've got a lot of new people in the room. In addition to that, we're going to be discussing investment matters, so I ask everyone to introduce themselves for the record again.
Okay, Rosemary T. Bellis, designee for Police Commissioner Bratton.
Susanna Vickers, designee for Controller Scott Stringer.
John Dosa, alternate designee for Controller Stringer.
John Adler, designee for Mayor Bill de Blasio.
Antonio Rodriguez, designee for Finance Commissioner Jack Jiha.
Brian Berge, Corporation Counsel, present by invitation.
Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, John Puglisi, PBA.
Joe Rayo, PBA.
Chris McGrath, PBA by invitation.
Gary DeRosa, designee for Ed Mones, SBA.
Steve Babili, designee for Luke Tarko, LBA.
Mike Endel, designee for Roy Richter, CEA.
Kenny Sparks, DEA.
Michael Palladino, DEA.
Karen Paxtis, DEA by invitation. Sherry Chancy, actuary, present by invitation.
Mike Haddad, Controller's Office by invitation.
Miles Braycott, Controller's Office by invitation.
Kevin Holleran, Pension Fund by invitation. Nicole?
Nicole Giambrisi, Police Pension Fund, present by invitation.
Vincent Diaz, Police Pension Fund, present by invitation.
And
Leanne Lunk, Mayor's Office of Pensions and Investments, here by invitation.
Carolyn Wilbert, alternate trustee for Mayor Bill de Blasio.
Phil Dukes, alternate trustee for Commissioner Jack Jiha.
And Kevin would like to just acknowledge, Rob, could you please identify yourself for the record?
Yes, Rob Appling, investment consultant with Wilshire Consulting.
Okay, thank you. With that, I'll turn it over to John.
Okay. So I had made a resolution several meetings ago, I think, to consider divesting our portfolio of pure play coal companies. We have received memos from the law department and from Wilshire, which I would summarize as saying that such divestment from Wilshire would have a de minimis effect on our portfolio, and the law department I would summarize as saying that it is within our rights as fiduciaries to vote to divest from these coal companies. However, it is my understanding that there is not support among enough of the trustees to go forward, so I will withdraw the resolution to divest the portfolio of coal companies.
And I would just add that while today there may not be enough support, in the future there may be support on this or maybe other matters, but not enough support today. So, and I want to thank everybody, the law department, for the work they did on it, and the controller's office.
That's right, there's a memo from the controller's office too, I forgot about that.
Correct.
Sorry.
Okay, so that resolution is withdrawn?
Yes.
I think there was the other issue on that asset allocation.
Next item?
Next item is asset allocation. And I would call everyone's attention to Appendix B in this handout. The Wilshire's updated asset allocation analysis. I'll turn it over to Mike.
Where's Appendix B?
And in this, at the end of this package.
I think better if Rob presents the joint recommendation from Wilshire and BAM. And it's a slight deviation from the last one that you saw from us, and I'm going to turn it over to Rob to kick it off.
Yeah, thanks, Mike, and this is Rob Appling. Thanks everybody for letting me join. Can everybody hear me okay on the phone?
Yes.
Yeah, we're good.
Okay, perfect. So I'll go through this quickly. I think I'd be more interested in hearing the questions and discussion because the material is very, very similar to what we've presented previously, as Mike alluded to. But just to get right into it, if you turn with me to slide 2, those are our expected returns for the different asset classes, essentially the inputs that went into the analysis. You can see the expected returns. I apologize, everyone has to squint their eyes, but you can see the expected returns and the expected risk for the different asset classes, and then obviously the correlation between those asset classes. And you can see at the top there, as of March 31st. So just as a reminder, we update our asset class assumptions quarterly basis, it typically don't change, significantly unless we have, maybe a market correction, for example, in a quarter. You might see our equity expectations go up and vice versa if we have a strong bull market. But for sake of time, I'll go right into slide 3. If you think back to the last time we spoke about asset allocation in early May, we showed you about 20 different portfolios, and today we decided just to show you 2. Your current portfolio and a joint proposed portfolio between Wilshire and the Bureau of Asset Management. Essentially, the reason why we showed you 20 portfolios in May is we wanted to illustrate the kind of the back and forth that's been going on in the background between Wilshire and BAM. And really, we wanted to make sure that we got the fixed income portfolio correct. And what I mean by that is we looked at several different ways of structuring the portfolio between intermediate or core treasuries, long treasuries, corporate credit, mortgages, and the other components of a typical investment grade or high quality fixed income portfolio. And ultimately, what the analysis from May showed, it's not necessarily how you break apart those 4 broad buckets of core treasuries, long treasuries, core credit, and mortgages. It's more so what your total allocation is to investment grade fixed income. And so in May, we showed you some portfolios where we kept your fixed income level the same at 18%. We showed you some as low as 10%. And I think ultimately, going with the conversations between Wilshire and BAM, I think we were comfortable with the level of 13%. But at a very high level, Wilshire from the very beginning was recommending that you reduce fixed income into some diversifying asset classes in order to generate a more attractive risk-return profile vis-a-vis a higher expected return while keeping risk either lower or keeping risk constant. And just to cut to the chase, that's what you're seeing here on the bottom half, the bottom box of slide 3, where you can see from where you're at today, up to this in May, your current portfolio is very well diversified. But we think, by making some changes at the margin, we can increase the expected return slightly and keep risk essentially the same or slightly below it. When you're talking about 4 basis point difference between 11.87 and 11.83, I would essentially say risk is the same, and we're able to keep increase expected return. So the only small difference between what you're seeing on this page and what we showed in May is I think there was some feedback and good feedback that given what we showed in May had slightly less in international equity and developed non-U.S. equity, emerging market equity. Maybe it didn't make sense given the fact that U.S. equity has significantly outperformed non-U.S. equity over the trailing several years, basically since the crash. It might not make sense to be a seller of those assets right now, especially where valuations look. And so that's the primary difference, is that international equity, instead of being 8 and 4 respectively, it developed and emerging is now 9 and 6. So a small change there. In order to make that work within the basket clause, we picked down real estate to make that work with anything above 10% in international equity going into the basket clause. So you can see at the middle of the page there, total basket clause assets, increased from 23 to 25%. So I can go into more detail, I can answer questions, but let me pause there since I'm on the phone, and I want to make sure I'm using your time effectively. Let me pause there and see if there's comments or questions before I go forward.
Okay, I'll ask a question. This is John Adler, Rob. So, in looking at the evolution of your proposed asset allocations to us over the last few months, it seems like by small amounts, the expected return has gone down, so that the expected risk has gone up. So the proposal that you made to us at the March meeting, the one that you were pushing, which was 2A, had an expected return of 6.74 and an expected standard deviation of 11.76. And then that went down a little bit in the May proposal and then goes down further in this proposal. So this proposal, if I'm not mistaken, is 6.66 for the expected return and 11.83 for standard deviation. So that's a reduction of 8 points in return and an increase of 7 points in volatility. And so I guess I would just ask if you can explain, why we should pick a allocation that has a lower expected return and a higher standard deviation.
Yes, John, thank you for the question. And just at a high level, the portfolios that we showed initially had a higher allocation to private equity. So
that's true.
Yeah, the original one that said 2A, I believe, had 10% in private equity.
Correct.
And each one subsequently from there was at 7% private equity. And when I think of private equity, first of all, that's the difference between the lower expected return. Private equity is one of the asset classes. If you look at slide 2, that is above 9%. So that would be by dropping private equity from 10 to 7%, you are giving up some expected return. What I'll say about that is when Wilshire shows a 10% private equity, it's kind of a hypothetical allocation because it's like steering a battleship. You just can't move up 3% in private equity tomorrow, especially with a plan that's $33 billion. It's going to take a lot of commitments and a lot of time to do that. And so with our conversations with BAM, we're comfortable continuing to show 7% in private equity, knowing that's a moving target and that's something that can be revisited as opportunities in private equity come available. And especially given where we're at right now, where buyout multiples are at some of the highest levels since 2007. So that was one of the reasons why expected return dropped, is because private equity dropped from 10 to 7%. On a risk standpoint, one of the changes I think we discussed in May during the different iterations of this is we also took out 2 lines. We took out a line for U.S. low volatility equity and a line for international low volatility equity.
Right.
We did some education in previous meetings on low volatility equity, talking about how we think those are compelling because they can generate a similar type of equity-like return with 20% less volatility. We have some clients that include those as part of their strategic asset allocation, and we have some clients that like to include low volatility as a structural decision or an investment manager's decision rather than a strategic asset allocation decision. And in our conversations with staff, they felt more comfortable with the latter. We're fine with that. So while low volatility equity is not shown on this analysis, it's by no means dead in the water for a potential future allocation for police. But with that said, by taking those out, by taking out an equity-like return with less volatility, it does reduce the volatility that you see in these portfolios marginally. So I apologize for starting with kind of the nitty-gritty answer to your question. Overall, we really would view these portfolios as identical. I mean, when we start talking about a 5 basis point difference or 10 basis point difference between portfolios, you're talking about a level of precision that is really outside our standard, our typical margin of error when we're talking about very long-term, 10-year annualized return assumptions. So while we'd like to be able to tell you that the second decimal place in these numbers is we're going to hit the bullseye 10 years from now, the chances of that are very low. I think when you start looking at the first decimal point, I think that's when you're starting to see things that see trends. And when we're looking at your current portfolio, I think we're still able to see a trend of increasing expected return while reducing risk. But there are some components that have changed these iterations that more specifically answer your question. Hopefully that helps, but I'm happy to give more color on that.
I have one more question, unless somebody else wants to jump in.
It's your dime.
I thought it was yours. One other question that I'd like an explanation on. So, looking at how in this iteration you added to international equity a total of 3%, and reduced opportunistic real estate and core real estate by 1% each, and you explain that by the reductions in the real estate because of the increases in international equity, creating a basket issue, which I understand. But if we just look at your return and risk assumptions as well as the correlations, if you look at opportunistic real estate, it has a return assumption of just over 10% with a 25% standard deviation, whereas the emerging markets in particular, all of your equity except for the low vol, all of your publicly traded equity has a return assumption of 6.5%. So that's like 3.5% below the opportunistic real estate. And if you look at the emerging markets, its volatility is 26, essentially the same as the opportunistic real estate. So why would it make sense to put more into emerging markets and take it away from opportunistic real estate, not even getting into correlations where the opportunistic real estate has consistently lower correlations to the rest of the portfolio, in particular the equity part of the portfolio?
Yes, that's a tough question to answer. I really think the basket clause is limiting us into what we would like to do, and I'm not trying to get on a soapbox at all, but what stands out to me when I look at slide 3, and I'll be sure to answer your question, but what stands out to me on slide 3 is the 31% in U.S. equity. I think that's really where we would like to take assets from, but we have to work within the basket clause in order to do that. If I think of a part of the market that has been hot or been heating up, even over the past few years, it would be real estate. I was just in a client meeting this morning where we're talking about key risks for institutional investors, and I would circle real estate as one of those asset classes that has done so well that I would proceed with caution. That being said, if you're a long-term investor and you've got the right horizon, the points you made about it having opportunistic real estate in particular, having a higher expected return, I would not argue with that. But if I'm taking from an asset, I'm comfortable taking it from real estate, given A, the basket clause, and B, the current market environment, whereas emerging markets on conversely have really been beaten up significantly. I think one of the drivers that we need to see a rebound in emerging markets would be an increase in commodities and some measure of inflation going forward, and we haven't seen that. But the valuations for a long term look attractive with emerging markets. The one, not to put any red flags up against real estate, but given the sentiment now with the Federal Reserve, I think the chances of them raising rates in June, or last I checked, were about 1%. Still really low for July. Probably at the end of the summer, sometime in September, maybe by the end of the year, we'll see some sort of hike and maybe end the year at 75 bips or something like that for the overnight rate. But that's one thing that's helped, the real estate market over recent periods is the low interest rate policy. And given the fact that, we may not see a rise in rates significantly this year, I think that's one helpful component for real estate. But overall, I'm concerned about the valuations of real estate. And if I can't pull money from U.S. equity, given some limitations of the basket clause, I'm comfortable taking, with a 2% out of real estate.
And John, if I can add from BAM's perspective, in the previous iteration, we had EM equities going down from 6 to 4, and through some discussion, we were uncomfortable liquidating any EM equities at these valuations. And from a risk-reward and valuation standpoint, we wanted to keep the EM equity allocation the same. And then one other thing I just wanted to share with the room is with the work of OGC, we've gotten more comfortable running the basket clause at full capacity at 25%. What they have asked in return from us is a detailed way that we're going to monitor it and how we might make changes to it if we go over it for some period of time. So Miles is all over that, and with doing that, we're able to take some money out of public U.S. equities and put them into international equities, and this proposal in front of you has basket clause at 25%.
All right, Rob Zantonio, a few questions. First, obviously, the big kind of issue or the largest change is the makeup of our kind of fixed income portfolio. And you had previously been kind of proponents of kind of core fixed income or more Barclays Ag-like structure, and now the joint recommendation between you and BAM now ask for long treasuries. Obviously, the implementation of this would be kind of over a period of time, and wanted to ask you if you had, given that's going to take place over time, to what extent would you all be open to something that in a allocation to kind of intermediate treasuries, and an ability to go between intermediate and long treasuries given market conditions?
Yeah, it's a good question, and I think from Wilshire's perspective, we would be open to that. I think we looked at, in the May meeting, we looked at, 20 some odd different scenarios for fixed income where it was all in long, it was all in core, it was 50-50 of both. And, we're not in the business of timing interest rate moves. And obviously, if interest rates go up, that could hurt longer duration fixed income. But we don't know when that can happen. Perfect example is the Fed raised their rate in December, but since then we've actually seen interest rates go down. And in the first quarter, with the flight to quality, go down quite significantly. So if there's some heartburn about going completely into longer duration, that would be fine to do some sort of systematic approach or dollar cost averaging from core into long duration. What I would say is we can't get that right. We can't time that perfectly. We can try our best to do it systematically. And like you said, with a portfolio this size, it's going to take some time to do that anyway. What I would add is that, long duration treasuries do add a component of short-term tail risk or short-term risk against volatility in the equity markets. And if I look at your portfolio from a 40,000-foot view, it's still, dominated by equity risk, and we're still operating in an environment where it's risk on, risk off. We saw a microcosm of that in the first quarter. A very, this is probably an oxymoron, but a very strong microcosm or a big microcosm, or you want to call it that, where we started the year with the worst start in the equity markets in history, and then by mid-February things began to rebound. And now I'm reading articles on Bloomberg where we're close to reaching a new all-time high in the S&P 500. And so, with all that being said, what we liked about the duration, the longer duration treasuries, was they do provide diversification benefits in those periods of market stress. And if there's no significant expected return and risk differences at the total portfolio level, we're comfortable with long duration of the portfolio. That's why you're seeing what you're seeing. So, I'm being a typical consultant where I'm talking on both sides of my mouth here, but we like the portfolio you're seeing in front of you, but if there is a plan over time to strategically move from core to long duration, that can, from an implementation perspective, that can make sense too.
Thank you. Thanks. And then
Can I respond to that as well? And I'll be less consultant-like and more definitive, and why BAM is very positive on this proposal. Total core fixed income is going down. It's going from 18 to 13%. But by increasing duration, we're increasing some key measurement metrics of this portfolio, and specifically the duration of the core fixed income portfolio, as well as the dollar value of a basis point. So by increasing the duration of the portfolio, despite having less assets, we're getting the diversification benefits that models out to be for us. So, we like moving money into higher yielding and higher return assets, but at the same time achieving the diversification benefit. And to do that, we need more duration in the core bond portfolio.
And then my second question, actually to Mike and primarily to you all, but then Rob as well, and I think it's related, is that the asset allocation that's been presented to us, kind of the continued overweight to emerging markets versus the ACWI, the kind of dive into higher yielding fixed income, high yield in general, and then the complexion and the makeup of our core portfolio, where we're long treasuries and much smaller positions in credit and in mortgages. Obviously, it's been presented to us the first time really as kind of a it feels tactical in nature, and that's fine. But are there particular things that we need to receive to be comfortable, or things you're planning to kind of give us to be comfortable with a portfolio that looks much less like the market portfolio than in earlier iterations? Just saying, are there things that we should be thinking about, things that we should be asking for, if we were to approve this particular recommendation, to feel more comfortable, or you guys think we should to be able to feel more comfortable with monitoring a portfolio that looks much more different than the market portfolio than we've currently had.
Rob, I'll start, and you can jump in. So let me answer your second part of your question first. Post asset allocation, whenever that gets done, the next mission for BAM is a revision of the IPS and the annual plan. And within the annual plan will be very detailed implementation strategies, particularly around the core fixed income portfolio. So we owe you that, and we will deliver that to you. Your first question about the change, the reduction in the allocation to mortgages and credit. Correct. And the rationale is they are historically, by any measurement, very tight to the spread over treasuries, and that's a lot driven by central bank policy where they bought mortgages. So we think the valuation of mortgages and credit, you're not getting compensated for the extra risk that you're taking. For investment grade, the liquidity has dropped significantly, so bid offer spread is, transaction costs are higher, and gap risk is higher. So again, we don't feel we're being compensated for the risk we're taking for the extra return. By putting that money into treasuries and increasing duration, we're thinking we're getting the benefit of the flight to quality that can exist within that asset class. It doesn't exist in mortgages because of convexity risk, and it doesn't exist in credit because of credit risk. So that's it's the relative valuation of those two asset classes, as well as the convexity risk that treasuries do not have.
No, definitely. And I think I was more getting at the idea that we are making allocation decisions based off relative value in these scenarios. And I imagine that typically our when we've done a strategic allocation, it's never been kind of explained to us that in those type of terms. And so from a monitoring standpoint, the difference between monitoring a portfolio that has kind of tactical, or kind of relative value, I guess allocating from a relative value perspective may be different than monitoring a kind of strategic portfolio that essentially looks like the market portfolio, particularly in fixed income. And so I was just asking whether or not there are different ways that we should be thinking about monitoring you all versus a portfolio that in general is more static or and has less kind of a relative value kind of plays baked into it?
So one thing that several of our clients do within their fixed income portfolio, because we work with a whole host of different clients from corporate plans that are very focused on liability hedging to endowments and foundations, and obviously public plans like the police, is the fixed income allocation can look really different from client to client to client, and what they'll typically do is create some sort of custom benchmark that changes over time as the changes to the fixed income portfolio happen over time. So that could be one potential solution in terms of monitoring is how are these fixed income strategies done relative to our custom fixed income policy. And I know BAM has already done some of that to some extent as well. But to kind of answer your question, about going forward, if we're going to try to move more gears within fixed income, that could be one way to monitor it. But I don't know if Mike wants to add anything to that.
Yeah, I would also add what's standard practice in many plans is to have a reference portfolio, and we are happy to do that for you as well. And that's some kind of low-cost indexed, whether it's 65-35, 70-30, we can agree upon whatever that reference portfolio is, and we will measure ourselves versus that reference portfolio in addition to what Rob suggested.
Thank you.
Yeah, I'd really like to encourage that, our regular reports also show the reference portfolio, and given the, given the breakdown here, I definitely think I would push towards a 70-30. I mean, the way that Wilshire breaks it out is growth versus hedging at 75-25. So, I mean, I think 70-30 is, kind of close. Some of the growth assets are, hedge funds and other fixed income stuff that is, could belong in the 25.
Yeah, I think it's probably either 70-30 or 75-25. I think we should match to the growth assets.
Okay. And can I just make one more point? Oh, go ahead, Rob.
No, I was going to add one thing. I think maybe Antonio was saying something about ACWI. I just wanted to clarify one point on ACWI. Now we're talking about equity. We're talking about the All Country World Index, which is essentially half U.S. stocks and half non-U.S. stocks, including emerging markets. And I just want to clarify that relative to ACWI, your overweight is with U.S. equity, not with.
So I did say ACWI. I said ACWI ex-U.S. So
okay. I apologize. I'm on the phone and I kind of heard something I did.
No problem.
So just the only other point I'd like to make is that, and I guess I'd ask Wilshire for your opinion on this. This is the first asset allocation that we've done in police in about 5 years, if my memory serves, since I wasn't here 5 years ago. But I believe that that's right. And I would like your view on, especially given the relative value issues that Antonio talked about when it would be appropriate for us to revisit this strategic asset allocation, because I don't think it's 5 years. Do you have a view on that, Rob?
Yeah, no, I think it would. So I would say that these portfolios that you're seeing on slide 3 are long-term strategic portfolios. I think it's good to be valuation aware and know what's happening in the market, and as opportunities present themselves, to be nimble enough to be aware of those opportunities. But this is a long-term target, and I wouldn't view this as a tactical nature. Obviously, there's some art that goes with the science behind the numbers that I mentioned earlier in terms of, for every dollar you want to put into one asset class, where is the dollar going to come from between, real estate and non-U.S. equities and those kinds of things. But I would view this as a strategic asset allocation, and I think 5 years is a prudent time, with the caveat that as markets change, if we need to look at that, 4 years, 3 years, or something like that, that makes sense. But I wouldn't view this as a tactical strategy where we should revisit this on an annual basis.
This is Roy. Is that something that's shared in the industry? Because I know in my annuity fund, we do it on almost like a semi-annual basis.
Well, Well, there's a strategic asset allocation that we're talking about today, and then there's, kind of structure decisions or investment manager decisions. So you can set your strategic policy, and then to the extent that opportunities present themselves, you can do that. But I think it is fair to say that it's kind of an industry view to design a strategic asset allocation and look at that, every 3 to 5 years. If something changes, a lot of times when clients will look at something sooner than 5 years, more on the 3-year side of things, is if something changes with their particular situation. Maybe they have some significant cash flow needs, or something changes with a pension plan. Something changes with their liabilities, and it's prudent to relook at some things. But I would consider what you're seeing on slide 3, a 3 to 5 year type of analysis.
I think from
Can I ask BAM, for their perspective?
I think we're more in the 18 to 24 month window to review it again. I concur with what Rob said about this is strategic allocation, it's meant to last, but I think the unique situation we are in markets, the unique position we have in global central banks with negative interest rates of something like $10 trillion of government bonds, it warrants more than standard review of this in terms of time.
I have to say, from my perspective, I tend to agree with BAM, that looking at this in 18 to 24 months, again, would make sense. Not necessarily we do a wholesale revision, but to sort of take a hard look at it and see if this makes sense given the market conditions at that time.
And can I just ask one question on the allocation itself, now that we were just talking about it, but on the long treasuries, and I know you probably discussed this in the past, but you can just bear with me, but you went from 0 to 8%. Is that based upon the last 5 years, or is that based upon your forecast for the future 5 years?
Future, everything that you're seeing here is based on future expected returns annualized over a 10-year horizon.
Roy, also, it lists core fixed income with 18%. If you were to break that down into the 3 sub-asset classes, what you'd really get is long treasuries with 4, mortgages with 7, and investment grade with 7. So we're really going from 4 to 8, and we're contracting in investment grade and contracting in mortgages.
But you're also looking to extend the duration on the treasuries.
Yes.
So the current treasuries duration is about 8, is that right?
Yes, that's correct. It's the treasury component of it is around 11, but there was a tilt done by BAM 18 months ago, where there was an overweight in equities, and that overweight was taken off and put into fixed income. The second tilt was, instead of putting it into the indexed amount, we put it into shorter duration because we held the view that interest rates were going higher at the time. So if you combine those 2 buckets of government bonds, the duration is around 8.
And that view has changed?
Consultant, yes and no answer. No, we still think.
I'm sorry. I couldn't. Is there a question? I'm sorry.
No. The view has changed, but not from a view on rates, but from a diversification benefit to your portfolio. So we hope interest rates are going higher because that implies some type of positive growth, positive inflation environment, and 75% of your portfolio is doing well, and we would love to lose money on this 8% part of the portfolio. In the event that we face a global deflationary environment, that 75% of your portfolio is going to suffer, and this portfolio, this component of it is going to add significant return to it. So it is diversification. You could call it insurance. It's a hedge against a very heavily tilted growth portfolio.
It sounds like he evolved rather than changed.
Evolved. Tweaked.
Like Obama.
Let's not get carried away.
So the recommendation has been provided to everybody. If there's no further questions, if everyone's satisfied with the explanations that they've held, I guess we would invite a motion if folks are interested in accepting this, and I'll leave it to the board to go from there.
What do you want to do?
It's up to you. If you want to take some time to decipher the answers, or are you comfortable with it?
I'm comfortable with it.
Okay.
Joe, if you guys are
I'm
comfortable
comfortable with it, so I make a motion, we accept the asset allocation proposed by Wilshire and BAM.
Do we have a second?
Second.
SBA, all in favor?
Aye.
Okay, so moved.
Thank you. And very quickly, I think the last item on the public agenda in this session is the BAM budget request that Scott Evans presented to the board at the previous meeting. And everybody has a copy of the numbers in front of you that we're going to the board to seek approval for. One note, there's a line for fringe that's included. We've had conversations with OMB, and it's probably prudent to look at this projected cost without the fringe, because that's typically allocated in the budget in a different budget line than your forecast. So the bottom line number for the total projected new need, or the total projected cost for police is not the 2.4 number, but the new total without fringe is 2.356709.
And that's, how much is that an increase over the current budget? Can
The
you tell me that
total
number?
projected new need would be reduced from the 796 number to 674,960. So we can achieve all of the new staffing, all of the new technology, all of the new initiatives that Scott outlined for an additional cost to police, a projected cost of $674,960. Are there any questions?
How many overall positions now will there be after this is done?
Overall positions in BAM?
Corpus, right?
Yeah.
Corpus or overall?
Corpus positions. And then compared to overall.
So there would be 9 new hires, and we currently have, I think we have 55, so it would be 61.
61 corpus.
64.
Sorry. Corpus funded, city funded is 55, I'm sorry. I'm reading this in the wrong direction. It's 61 plus 9 equals 70. Corpus funded positions.
And then 55 city funded.
So BAM would increase from a headcount, approved headcount currently of 116 to 125.
So we went from like 60 some odd people to, no, earlier on. How many people were in BAM before the changes? Wasn't that many?
Before,
Yeah.
there are always a lot of open positions, so
Yeah.
how you count people is difficult. But the head count of approved staffing would increase by 9. Any questions or thoughts from the board?
As long as we could get John an office, that would be a good thing, instead of a cubicle.
Why, thank you, Joe, I appreciate it.
You know,
I will duly note that and pass it along.
Let Mr. Stringer know that, you know, we were very
John's-
nice to him today about custodial.
He's gonna get you pushed right into
and all this
the
other
hallway.
stuff. We'd like to see Dorsa have an office.
Does it
Preferably
count?
so he could greet us with cookies and tea.
As long as he doesn't charge it to Corpus.
Right.
Yeah,
I think if he
that's
gets an
pretty
office, he'll be
expensive.
more inclined to actually pay out of his pocket. Crumpets and tea.
We'll take that under advisement.
We'll show the video.
So,
Just make a motion that we accept the corpus funding increase.
yeah, second.
Second, all in favor?
Aye.
Chorus of ayes.
Thank you.
Okay, we need a motion to adjourn.
Motion to adjourn.
Okay.
Leave me to it.